There's the reaction in the U.S. equities. Investors a little despondent today. The S&P 500 holding above the 5K mark, but we did get weak U.S. GDP data and unpleasantly high inflation indicators. Our guest says investors should be prepared for interest rates to stay elevated for some time. Let's bring in Jason Schenker, president of Prestige Economics. Jason, thanks very much. Are we into stagflation? Have we come to that point?
I don't think we're there yet, Andy, especially with GDP at 1.6%. That's a solid number. Stagflation, we'd expect it to be a lot closer to zero, but the Fed's top concern right now is still very much inflation.
Do you think that they might even raise interest rates? I know that's a drastic scenario.
It is possible, right? The Fed has a dual mandate, low stable prices and full employment. And right now, we clearly have full employment and the jobs numbers are all really good. But what we don't have are low stable prices. So if we continue to see the CPI and other measures of consumer inflation remaining elevated, the Fed could conceivably think about raising interest rates further.
That would be quite a shock, though. Well, I mean, I guess people are becoming used to the idea. Sorry, Jason, go ahead.
Yeah, no, I mean, it sounds surprising because just a few weeks ago, the Fed was talking about doing 3 interest rate cuts, and now they're talking about no cuts. And now to think, well, actually, maybe they're going to do raises. It is surprising, but I do think the economy could handle another 25 or 50 basis points in rate increases, especially considering how far we've come and how strong the job market is. But it's something that would definitely cause more volatility in equity markets, currency markets, and commodity markets.
I suppose for years, companies had no pricing power. They've had the pleasant experience over the past few years of being able to jack up their prices and get away with it.
Well, I mean, if we look at some of the different indicators, whether we're looking at the producer price index on the manufacturing side, that looks much flatter. Year on year, that's changed very, very little. But on the consumer side, where we see the pressure really coming from, especially in that CPI, is in that shelter index, that housing cost that we see up everywhere. So I don't necessarily think it's companies trying to gouge consumers. I think it's that we have very low rental vacancy rates in the United States. We have very little new construction for housing, and we have record numbers of people on payrolls. So people making more money than they've ever made, with more people on payrolls we've ever had. They want to live somewhere. There's not much to rent. There's not much to buy. So that part of CPI, which is about a quarter of headline CPI and about a third of core CPI, that could be stuck for a little while.
The accommodation, the housing cost?
Yeah, that's right. If we look at that owner's equivalent rent piece, that's a quarter of total CPI, a third of core CPI, and of course that's up significantly year on year.
I know The Economist magazine has been talking for quite a while about how we've too much money invested in housing. Housing is taking up too much of people's income. I don't know, should we settle for smaller houses and apartments?
Well, we'd have to have people wanting to build a lot more smaller houses and apartments. And of course, with elevated mortgage rates and high interest rates, it's tough to get builders to want to build a lot more multifamily structures. We look at the multifamily starts, those are still under pressure. So we would need something to incentivize that building. But with high interest rates, that's something that could prevent the additional building, that could provide some relief on that part of the inflation equation.
Yeah. I guess it's a bit like the automakers. They like to build big cars, big SUVs. They make more money. And I presume you make more money building big houses. I'm not sure.
Well, at the end of the day, Andy, it's true that what we see as people look at pricing houses, a lot of it does have to do with the square footage of the house. But as we're thinking about apartments and things like that, multifamily structures is really where you'd expect to see relief. But even on the single family side, some of those starts are still under pressure as well. So not a lot of construction happening with mortgage rates back above 7%, with the potential they could go higher.
And you have that weird housing market, don't you? People stuck in their house. They don't want to give up a 4% mortgage.
Well, that's right. Especially for folks, 4% or even lower.
Yeah.
Those folks want to stay in their houses as long as possible, because otherwise they're going to go into a house with a much higher interest rate. So you do have a less liquid housing market, but in general, you also have less to rent. If we look at the rental vacancy rates right now, prior to COVID, you'd have to go back to Q2 of 1985 to find rental vacancies as low as they are right now. So there's not much to rent, and that means we might not see much inflation relief on that part of the equation. It means the Fed may be forced with a really tough decision. Do you keep interest rates high, which prevents a lot of new building? Do you raise it, which disincentivizes building more? Or do you still think about cutting, even though we're well above the Fed's 2% target?
What about the election, Jason? I know we're going to be hearing about it ad nauseum as we move into the summer, but is it the headlines, et cetera, are they likely to have an effect on the economy? I mean, a lot of it is political heat and noise, I guess.
There's a few pieces that I think are really going to drive what happens this fall. Number one is we've looked back at elections over many different cycles. You look at the past century, there's only one economic indicator that matters. That's the change in the unemployment rate from the midterms to the general election. There's only been 5 presidents who have not been reelected in the last 100 years. Those are also the only 5 times we've seen the unemployment rate go up from the midterms to the general election. That was Herbert Hoover, Ford, Carter, George H.W. Bush, and Donald Trump. And right now, the unemployment rate's a little bit higher than it was in the midterms. It was 3.6% in the 2022 midterms. If the unemployment rate's above that, based on 100 years of data, you would expect the incumbent and the incumbent's party to lose. So that's going to be really important. I also think bottom income quintiles are very focused on inflation. And if that remains a problem, it's something people see every time they go to the supermarket, right? It seems like you're almost luxury shopping, eggs by Gucci, right? Like that's what it seems like when you're going to the supermarket for many people. And, that really hurts people in the lower income quintiles, and they will vote.